Hi everyone! Today we will be discussing private placement memorandums, private placement offerings, the term sheet and the anatomy of it, and due diligence. We will begin by discussing private placement memorandums, or PPMs, and the regulations against them. A PPM is a factual legal document that a business uses as a security document. Its sole purpose is to gain interest from private parties on a particular securities investment. It includes various aspects about a company. For example, a description of the company, legal factors, risks of the investment, which is one of the most important parts, and the subscription agreement, and so on. So, for PPMs, there are certain exemptions under Regulation D of the Securities Act of 1933. This proposes exemptions for companies and businesses such as solicitation or advertising. It also has exemptions for companies that are making certain amounts of money, such as under $1 million, $5 million, or other higher amounts of capital. Many people confuse PPMs with business plans. However, business plans are far more marketing-oriented, while a PPM tends to focus on the risks and disclosures of a company. We will now discuss private placement offerings, or PPOs. These are alternate approaches to raise capital and are usually taken instead of the standard initial public offering or an IPO. So a company may decide to take the private approach because it does not have to be registered with the Securities and Exchange Commission or the SEC, and therefore there is less paperwork and expenses involved. It also allows for a quicker entrance into the market and to its competitors. A PPO is typically taken by riskier businesses, such as a startup company. These companies take the PPO approach because it makes it quicker to underwrite securities and more complex securities can be sold. However, since it is riskier, the investors do also expect a higher rate of return. They are typically called angel investors because they are essentially there to save the day for a startup, and basically, since they are believing in that company and its risk, they do want a higher return. So with a PPO, of course, there are regulations. For example, under the Securities Act of 1933, businesses must abide by state and federal securities laws. Again, no advertising or solicitation is allowed, and the number of offerees should remain as minimal as possible. Furthermore, the financial statements should be clear and provided to the potential investors. So we will now discuss a term sheet, which is usually introduced pretty late in the process of a transaction or deal. So this is a non-binding agreement between all the parties involved. It outlines the terms of a transaction in very specific and concrete detail, and some of the common key terms in a term sheet are the valuation of a company, the price per share, liquidation preferences, registration and voting rights for the investor, cash-oriented goal, and anti-dilutive provisions. A term sheet may also include details about the board of directors and other higher-ups in a company. Because it is able to be negotiated, an investor can potentially talk to the company and get certain things changed since the term sheet is non-binding. And it is often compared to a letter of intent. However, a term sheet is less formal and can commonly be seen in bullet format. Finally, we will discuss due diligence. Due diligence is an investigation and evaluation of a business opportunity presented. It ensures that all financials and company information is accurate, and it allows an investor to decide whether the existing risks are able to be mitigated. Due diligence is mandatory from individuals like lending institutions such as banks and credit unions, and they must perform it on all individuals or firms before extending credit, just to make sure that these people can be trusted. Furthermore, due diligence is essential to venture capital firms, and they must perform it before taking an investment interest in a firm. Individuals may perform due diligence when they invest in the stock market, and they actually look at the financials and such of a company to determine whether or not it is worthy of their investment. So overall, PPMs, PPOs, the regulations on them, term sheet, and due diligence are all very important concepts to understand in finance. Thank you and have a good day.